beauty of passive is simplicity. If you were to choose an option, when you start looking at capital market, what is that will begin from? That's where it simplifies the investor's job. He doesn't have to look at too many things. So it's a very good starting point. Passive also helps you to make your core portfolio and increase your appetite to take risk.
In a passive fund, you will live and die with the market, right? And active fund manager tries to ensure that you don't die with the market. If you entrust a fund manager to be making calls for you that at this point of time in the market, this sector will do better, this company will do better, and if you have that confidence and if you stick with him for the longer period of time, that will give you a better return. So I think ultimately it is about investors' comfort, right? Which mode gives him more comfort, because really your return outcome, the most important factor is time in the market.
Right.
Legendary investor Warren Buffett in the year 2008 placed a multi-million-dollar bet. His bet was that S&P 500 over a 10-year period will give better returns than any actively managed hedge fund. In the year 2017, he actually won this bet. And this bet has spurred a debate over multiple years on how does active and passive investing fare against each other. Some facts: passive investment globally has already exceeded the amount of active investments that are happening. This is a very interesting topic, and it's very relevant to India in this time frame where Indian equity markets and Indian financial markets are just about maturing. In today's open dialogue, we will discuss this topic, and I'm joined by two stalwarts to have this conversation. Joining me are Ashish Gupta and Vikash Wadekar. Ashish is the CIO of Axis Mutual Fund. He has more than 25 years of experience in Indian equity markets. And he's a well-known name in the Indian equity research space. Vikash is the head of passive funds business at Axis Mutual Fund. He also looks at quant funds. Vikash has more than 2 decades of experience in the AMC industry. He was instrumental in setting up the BSE Star Mutual Fund platform for the Bombay Stock Exchange. And these two gentlemen here are to debate and discuss and hopefully help us figure out the difference between these funds and what works best for investors. In today's episode, we'll cover multiple topics. We'll start with what is active investing and what is passive investing, which type of investors are these best suited for, how have they performed, and we'll also speak about some trends, contra trends, as well as latest happenings in this space. Ashish, let's start with you. What is active investing and what is passive investing?
So, Sameer, it's fairly simple. Active investing and passive investing, both are basically ways of managing funds where investors place some money with a fund manager. The fund manager's mandate is to look at the market or segments of the market. The markets here are determined by a benchmark. In an active fund, the fund manager is entrusted with the responsibility of beating that benchmark. In passive investing, the fund manager is asked to mimic the returns of the benchmark. In active investing, the fund manager tries to create excess return over the benchmark, what we call alpha in the market parlance, by really taking stock investments which are away from the index weights. In passive investing, on the other hand, the fund managers exactly in the portfolio mimics the stocks and the weights in the portfolio. Over the years, this has been gaining more and more popularity. Today, now nearly 50% of over 50% of funds in the US are managed on a passive basis. This has come to India as well and has been rapidly growing. In India, I think the number today is about 14-15% of total industry AUM is managed passively versus active.
So just to kind of summarize or synthesize in my own words, if you look at India, we have, let's say, Nifty 50.
Yeah.
So there could be a large cap fund, Axis large cap fund.
Yes.
In which you may invest still in those 50 companies, but you may say that I want to invest only in 40 out of the 50 because I don't like the other 10. You may also say that, in the Nifty, the weight of a company may be 5%.
Yes.
But you may like it more. So you will say, okay, I'll put 7%.
Absolutely.
That is active investing.
Yes.
Alternatively, you may have an ETF which basically says I am investing in Nifty 50.
Yes.
It will exactly mimic. It will invest in all 50 stocks
Yes.
in exactly the same weightage as it's in Nifty, and hence its returns will basically, with some error here and there, but will mimic what Nifty 50 returns.
Absolutely.
So the first one is active, the second one is passive. Great, thanks Ashish. Vikash, coming to you. So if you can just help us kind of run through this history of passives, like where did they come from and why have they become so popular globally?
Okay, so first of all, the beauty of passive is simplicity.
Right.
Okay, if you were to choose an option, when you start looking at it on capital market, what is that will begin from? That's where it simplifies the investor's job. He doesn't have to look at too many things. So it's a very good starting point, first of all. As you increase your risk appetite, okay, you can get into the other aggressive modes, like the PMS, CIF, or globally hedge funds also. But there what has happened, as market evolves, okay, I'll tell you about this. Generally, I give this example. If you look at, say, 10th board SSA results, what you see, there are few guys fail, few guys come in merit. Right? Now you take this classroom to IIT classroom. So what will happen? The first guy would be, say, 97, 98%. The last guy wouldn't be below 90% also.
Right.
So your classroom has evolved. Your market has evolved. Same thing has happened globally also. They have, of course, 100 plus years of history. So as the market participants increase, okay, the market intelligence increase, that IIT classroom is managing your money.
Right.
That is passive. So people realize that, in first semester, say one guy would come top. The second semester, other guy would top, because, it's a competitive market. It's the market wisdom has grown up. And alpha started reducing. And there also what happened, people got exposed to the hedge funds, very aggressive strategies as well. They realize, when you go to market, I am certain of some return and risk. And of course, costs are also lower. And I can increase my risk profile in the other part, which is the higher risk profile. Now, if you look at India, passive started picking up after the categorization, where the large cap, mid cap, and small cap, when SEBI categorized stocks and what is the exposure that a particular fund manager can have. And that's where the alpha started dropping, okay, or alpha was not consistent.
Right.
Second move was EPFO, and EPFO started looking at, say, 2014-15, when they started getting investment in the market. That's what the larger chunk in the passive currently is by EPFO. EPFO started, then your government divestment started, Bharat 22, CPSE, Bharat Bond, and that's where the passive. So government intervention actually helped passive to grow up, in a huge way. But it's still a government mandate which is driving in India. Okay, in the retail space, it's still lower. Okay, of course, now people have realized that they should also add passive for simplicity, because India, population-wise, is huge. Right, we haven't reached. You just crossed 4 crore as an investor.
Right.
Right, and if you want to reach 200 crore or also 10 crore, also the simplicity will help. That's where also passive is gaining. You begin with, say, Nifty 50, Nifty 100 or Nifty 500 simply, and then you add two other flavors as well.
So Vikash, just continuing this, if as a retail investor, I want to invest in a passive fund,
Right.
How do I do that? What are the avenues that are available?
First is, which is the popular, which you spoke about, Nifty 50 or Sensex.
Right.
You can say they are established business.
Right.
They are, you can say they are actually multinationals also now.
Right.
Right. Their businesses are very stable. So if you are not sure where to begin with, that's where you can begin with.
Right.
Okay.
But this is a mutual fund. It's what instrument is it that I have to?
Yeah. So passive offers two instruments: index fund route as well as ETF route.
Right.
So for ETF, you need to have a demat account and trading account.
Right.
Okay. Which of course now last 5 years we have seen a lot of demat accounts are increasing, but still to reach that population, it's still not that very large. Index fund again is simple. If you have a KYC registered, if you have a bank account, you can go to any website and just start your investment. So simplicity wise, index funds are very convenient. Okay, but whatever suits investor, they can look at.
So there are two routes. There is the ETF route, the exchange traded fund, which is you have to go to a broker and you have to buy it on a broking platform and it is tradable.
Right.
And then there is the index fund, which is a mutual fund. And so you don't need to be on a broking platform. You could maybe go to your bank or any distributor.
Correct.
And you can buy it from there. You can redeem it directly with the mutual fund whenever you would like.
Correct.
And these two avenues are identical, like in terms of, let's say, the costs and how the funds are managed? And so
Yeah. So globally, ETFs are very cost efficient.
Right.
Okay. Not only cost efficient, the overall efficiency of the portfolio is very high when you look at the ETF as a format. Okay. Index funds, because of the structure, they are slightly more inefficient if you compare with ETFs. But over long term, and if you look at the convenience, because ETF market has not evolved in India,
Right.
especially the liquidity on the exchange, right? So you end up paying brokerage, market making cost. So it works out to be similar. So, for simplicity, index fund route is best to begin with.
Right. And just in terms of cost, if you can highlight for us at the highest level, the delta between, let's say, a actively managed mutual fund versus passively managed fund.
Yeah, so in 2.25% on the highest side on active mutual fund charges, and maximum passive can charge is 1%.
Right. So there is a delta of 1.25%.
Yes.
There are within active funds, as you would know, there are two different classes, right? One are regular plans and the other are direct plans.
Right.
So if you look at an active fund and if the investor directly buys from the AMC, like he would buy an index fund, right? The cost is actually closer to 50 basis points.
Right.
And whether you buy an ETF or the index fund, the cost is about 20 basis points.
Right.
So the delta is only about 30 basis points.
Right. So now, Ashish, I'll come to you since you are on the active side. So A, the cost of an active fund are higher. B, there is lots of research globally which says that if you have a fund manager and you have a completely ignorant guy randomly picking stocks, over a long period of time, it is very difficult to distinguish between the returns of the two. So why should somebody invest in an active fund?
So I think I'll contest your second assertion.
Right.
So I don't know which research you have looked at. So I think there are statistics and lies, as they say. Right. So I think if you look globally, even if you look at India, right. So there are some research reports that go out and say that 60% of active fund managers have underperformed the index.
Right.
Let me flip it, right? How many of passive funds have underperformed the index?
Right. It should be zero, right? Because
100%.
100%. Okay. Yeah.
Right? So the fact is that all passive funds actually underperform the index.
Because of the frictional costs and stuff like that? Okay.
Right. And again, even if we just look at the active funds, there's a difference when you look at the data in terms of number of funds versus AUM.
Right.
Obviously, in active funds, people who are beating the index, AUM will gravitate towards them.
Right.
People who are underperforming, AUM will gravitate away from them. Right. And if you look at the same statistic on an AUM basis, the results are very different.
Right.
And again, US is quoted as an example. So even before I come to India and give you some stats on that, if you look at the US, I think the number on percentage of funds underperforming by number of funds is about 60-70%. I don't know the latest number. The last report I saw.
That's the number, correct.
Right. But if you look at percent of AUM that has underperformed, that is about 40%.
Right.
So 60% of AUM has outperformed the benchmark and 40% of AUM has underperformed. If you come to India, the numbers are very, very different, right? And if you take a 10-year view, in India, 85% of AUM has outperformed the benchmark. The excess alpha on an annualized basis that has been generated, and this is after costs, right? So after the fees is about 150 basis points.
Right.
So 150 basis points annualized over the 10-year period.
If the benchmark gave 12%, after cost, active funds have given the guys who outperformed have given 13.5.
And if you look at 10-year period, I think direct plans probably don't have or have just about 10 years history. So most of the AUM is regular plan where the cost is actually 200 basis points, right? Broadly, right? And if you look on a 5-year basis, again, the numbers are similar. About 70% of AUM has actually outperformed the benchmark. And again, I think the annualized alpha is about 70 basis points or so.
Right.
If you take more shorter term numbers, I think even on a 1-year basis, about 60% of AUM has outperformed the benchmark.
Right.
So I think one has to be slightly careful in interpreting headline statements. Right. And also you have to see that when you look at any investment, you have to look at returns over cycles. Right. You can't have short periods of time defining your return, because when market is in a very strong phase, so typically when you come out of a recession, right, every company's earnings are growing, right? So the earning dispersion is very low, right? At that point of time, really it does not pay to differentiate too much, right? You mimic, you get strong return.
Right.
When there is a higher dispersion, that's where the role of the active manager becomes much more
important,
to the forefront. And that's where you get really stronger outperformance.
So Vikash, I'll come to you. Actually, my role in this conversation is very easy. I have to pose tricky questions at each of you, right? And whatever he says, I can put to you and vice versa. So Vikash, is 80% of the AUM is outperforming, and is outperforming by 1.5%. 100% of passives perform worse than the benchmark. So why should somebody put money into passives?
Yep. So as I said, simplicity. First of all, it's about when we look at globally, people hear about active versus passive, right? Both are required. Both are required in the portfolio. But the beauty of passive is simplicity. You can begin with passive funds. Now, currently we have more than 150 plus strategies on passive funds, which you can invest in India, which includes debt and equity both. And 500 plus passive funds are available in India. So simplicity is something which is which is the beauty. Second, about something called core of your portfolio. Okay. This can actually take place of your core of your portfolio.
Right.
We generally keep it for 20 years, 30 years, right? And another experience of, what Ashish said, see, the guys are outperforming. There's nothing called, there is no outperformance. Definitely there is an outperformance. The question here is consistency. Okay, the guy
is the same guy outperforming for 10 years.
For a very long period of time that you don't see.
Yep.
Right? Guys keep switching. Of course, there are a lot of cycles and styles, also face because of underperforming because of their styles also. And their methodology also. So that creates a question in investors' mind, what should I do? Right? This guy was doing well when I started. Now, after 5 years, this guy is not doing well. Okay. They don't understand his style is not working. What's the methodology? What's the portfolio that I am buying? But they look at this. Simplicity, I'll put it. Suppose, so one is the beginner. Second, you are like a person, you have exposure to market, like 20 years you've been investing exposure. And I want to navigate in large, mid, small, everywhere. Right. For such investors, suppose you are picking a large cap fund or 2 large cap funds, I would say you should add 1 passive also.
Right.
If you're getting on a mid cap, say 2 mid cap or 1 mid cap, you should add 1 passive also. So within all the categories, so what happens? Your underperformance comes down. That's one. Your overall cost also comes down.
Right.
And your overall risk also in the portfolio comes down, because you're betting on particular fund manager, his style. Okay. You never know when you want to redeem after 5 years, 10 years, what his style will be working or not working, when the market would be at that time. I'm not saying he will not, right? But the probability, he may not also.
Right.
So, or he may also. That's also. So that's where when you add passive, overall your portfolio start looking good, rather than betting on just one. So what is passive? As I said, that IIT classroom which you are betting on, I may be slightly studying a small number, 1,500 plus fund managers are available in India, including PMS, AIF, mutual funds. Look at corporate treasuries, bank treasuries, stockbrokers, analysts. So many guys are there, right? So all those guys are actually betting for you. So you are actually betting on all that market wisdom, right? So yes, that's how one should look at. If you're in Evolved, you want to have a bigger portfolio, multiple options, add passive in each of category. That's what I would recommend.
Right. And if I can add here, so I think what is important is what gives investor comfort, right? And I'm sure you would have heard this about market. The most important thing to generate return in the market is time in the market.
Right.
And I think what with passives is that there is intuitiveness, right? That an investor knows very simply what his outcomes of investment are, how his investment is outperforming, because you can read what Nifty is doing, Sensex is doing, even if you're not reading the financial papers every day. So you are very sure which direction your investments are going. And therefore, if it helps the investor build confidence that this is what I've invested in, this is my outcome. And if that helps him stay longer in the market, then passives is for you. If you entrust a fund manager to be making calls for you that at this point of time in the market, this sector will do better or this company will do better, and if you have that confidence and if you stick with him for the longer period of time, that will give you a better return. So I think ultimately it is about investors' comfort, right? Which mode gives him more comfort, because really your return outcome, the most important factor is time in the market.
Right. So there are different needs that the two are maybe addressing. The first one, and again I'm paraphrasing, so please correct me if I'm wrong, is that, number one, it is better to be in some fund versus to not be in any fund is kind of point number one.
That's correct.
And hence, more than active versus passive, it is a question of whether you are investing or you are kind of not investing. If you are coming into the market first time, you don't have too much time to kind of, research fund manager A versus B and so on and so forth. It is better to put it in the passive because at least it is generating the benchmark minus whatever small delta, but benchmark returns.
Sure.
If you are an investor who's then, looking at, like, that fund manager X has a certain style that you're very comfortable with, you've done your research and so on and so forth, and you're gunning for the extra 1.5, then maybe, some part of your portfolio you can kind of put into that fund manager. So that's kind of broadly where this is kind of coming. Maybe Ashish, just help us understand, what does a fund manager do in an active fund?
Sure.
Why kind of is, and obviously we are paying higher for the fund manager. There's a difference, I guess, between the two.
Yes.
So what does a fund manager do?
So I think really the fund manager is looking at two things, right? One is how does he generate excess return over the benchmark? The second thing he is trying to do is how does he manage this better? And in terms of trying to generate excess return, you are looking at which are the pockets that are growing earnings better, or which are the pockets where the risk return trade-off is better, right? So you are doing your fundamental analysis, you are looking at earnings, what is the pocket that are growing earnings faster, which are the company that will be bigger in 3 years, 5 years. So you are doing your fundamental research, you are doing your technical research, what is the demand supply for the particular stock or the market, and whether you should be going overweight, underweight at that particular point of time in a sector. But a very important additional factor that is how he manages this, right? So in an active fund, there is multiple risks that are taken into consideration. So you are not just looking at risk of returns, but you are trying to manage the liquidity risk, you are trying to manage the event risk, you are trying to manage the default risk. This is something that's not done on passive fund, right? So for example, if a company that is going to go bankrupt, right, is in the index, it will still be in a passive fund, right? I think this debate is very pertinent on liquidity risk, right? Because there are pockets in the market that are very illiquid. Irrespective of the liquidity, in a passive fund, the stock has to be bought to the extent of the index weight. Right? When the times are good, markets are buoyant, these risks never really materialize, right? But the fact that risk does not materialize does not mean that this does not exist. Yeah. So for example, we did a study because beginning of the year there was a lot of debate about small cap, mid caps, etc. And actually, if you see last 1 year, most small cap active funds have underperformed the small cap index. Right? And so there is a huge debate that why should you do small cap active fund? Why don't you just do small cap index? The difference is that active fund managers and small cap is saying that I need to manage liquidity in a small cap. And so various funds, depending on the size of the fund, either have capped investment in certain small caps. So about 15-20% of the fund moved to large caps, right? Given there was excessive fraud in some valuations, or people had very large cash balances, because if there is redemption, then these small caps are not liquid enough given the fund size, right? In a passive fund, you will live and die with the market, right? And active fund manager tries to ensure that you don't die with the market.
Right. So what does a passive fund manager do, Vikas, then?
So his job is very clear. He has to mimic the index.
Right.
Okay. And mimic to the extent that, there is something called tracking difference or tracking error, which is lower. What is the index has given return and what is the fund manager has delivered. But there are a lot of other things also which are part of the this process. One is twice a year the rebalance happens. Like new stock come in, old stock go in.
Of the index, rebalance of the
index. And then you have to do it on the same day. Suppose 31st of July, if some stocks are going out, okay, and the stocks should be, and new stocks are coming on 1st of August. You have to sell, you have to keep those stocks till 31st of July, and new stocks should be added on the 1st of August. Okay. So this is one which happens, of course, twice a year. But there are a lot of corporate actions that he has to get into. Okay, he has to manage cash flows. He has to make sure that every day which money comes in, you cannot hold the cash. You have to invest everything, and especially to the last half an hour.
Right.
The execution is very, very important there. Of course, market supports you because any index is created also based on liquidity. Okay, that aspect is already there. So when you manage a large AUM also, market will be able to absorb that. But he has to do that. Another thing, he has to also make sure that that gap execution, because of the cost and execution challenges, dividends and all, how can you reduce that cost, that gap as well? So you can do lending and borrowing of stocks, if you can do that, so we can reduce that tracking error. So the job is to mimic very close to index. It's very, very difficult. Okay, I'm not saying that, but it's a process.
Right.
Okay, he has to also make sure that during the day, if particular stock is in circuit of particular index, how is he going to manage it?
Right.
Because the stock is there in the index. Okay,
but you can't buy or sell it.
But if you don't buy it, there is a tracking error also which will come. So how will you buy it?
Right.
Can you buy it throughout the day? Can you buy it next day?
Right.
Okay, so all those things. He has to basically on top of the toes throughout the market to make sure that there is a liquidity in my fund, and I am very, very close to the index.
So it's constantly like the passive guy is constantly executing trades. Because through the day also the index weights will move and some stock price will go up, go down. He has to rebalance accordingly. So Ashish, coming to the active side, last question on how fund managers operate. Like this generation of alpha, the price discovery is extremely transparent, right? Like there are trades being placed every second, every microsecond, and in very large numbers. And there are very large number of players, Indian, foreign, active, passive, and so on and so forth. There also, by the way, there is a big FNO market. There is some stuff happening there as well. So how do you generate alpha, and that too consistently?
So I think really it's a process. I think people try to generate alpha through different processes. Vikash also alluded to the fact that there are different styles that are in both at points of time. There are different styles that are not. So some people try to generate alpha by going for value. So they look at stocks that are cheaper. Some people try to generate alpha by growth, companies that are growing faster. Some people try to generate alpha by doing thematic investing, the themes that are going to be bigger. There are some which are a mix of these. Some people try to generate alpha by trading technicals. So the quest for alpha is sought through multiple ways, and there is no one way that will give it to you consistently. But I think the fact is that we as an economy are in a stage where A, growth is high, B, dispersion of growth is very uneven, right? And therefore, we believe there is enough opportunities to really make active calls. Therefore, over the period of time, in India, there is opportunity to generate alpha. But yes, alpha is cyclical, so no one style will consistently give you alpha year over year or month over month. But still over a long period of time, till the time economy is in a high growth phase, till the time there is differentiation above income, I think you can generate.
And you think that potential is higher in, let's say, India versus a more mature market like the US, or is it similar, or like?
Frankly, while we call the US market mature, the growth in US has actually been fairly good, right? So I think you'll find generating alpha being more difficult when the dispersion is less, right?
Okay.
Not necessarily just growth, but dispersion is less, right? And yes, when the economy is not growing strongly, when everything is steady, calm waters, then the dispersion is less and generating alpha will be more difficult. And potentially for differentiation goes up when there is more growth in the market.
So moving on to the psyche behind investing, Vikash, and this question is to you. See, active fund managers are applying some mind and they are saying this stock should be priced at so much and this must should be valued at so much, and so I'll buy this and not buy this and maybe sell this, whatever, right? Passive funds are just blindly following the index. So if majority of investing is in passives, or let's say hypothetically, if let's say all investing is in passive, then how will price discovery happen, and what happens to market and risk? And because at the end of the day, the markets is a way to discover price and manage risk.
Few people mistake that, if everything becomes passive, what will happen? So we have to also understand passive is the outcome of active investment style.
Right.
This classroom is not SSC classroom now.
Right.
If you have to have an IIT classroom, to generate that wisdom,
Right.
there has to be somebody saying that this price that market will not accept a particular stock. Okay?
Right.
And this valuation market will not give that price, right? So there's an active management is required, okay, to have to passive to work. Now, what is the outcome of that? Okay, let me tell you an example. Some of the stocks, so one of the group stock, I don't want to name it here. People know it, and none of the fund managers on the mutual fund side, holding that stock in the portfolio.
Right.
Right.
None of the active.
None of the active side. Okay, but that stock came into index.
Right.
50-50.
Right.
There is an issue happened. The weightages came down. Again, it is doing well. So there is a style of fund managers. They are saying that yes, we are not comfortable with a particular group, a particular stock.
Right.
But the market is huge.
Right.
There are a lot of other players who are also comfortable with this.
Right.
Right. So when you bet on particular style or a fund manager, you have to also understand that market wisdom is much more powerful. They know how to give a particular price to a particular stock and when to take out that price. Okay, that happens very quickly, and that is very evident when there is a recovery happens. When see, active fund manager, as Ashish said, there's a lot of thought process goes why a particular stock comes into a portfolio, because he has to look at long term. But at the same time, he has to also manage liquidity because
Absolutely.
we are managing public money.
Yep.
Right. So particular large cap portfolio will have a mid cap also.
Right.
Mid cap portfolio will also have a large cap. Right. So there is no pure risk which you get.
Right.
Same thing what you get it from passive. When you get a large cap, 100% large cap.
Right.
Mid cap, why you go to mid cap? For that extra risk, you have to have 100% mid cap. Small cap, 100% small cap. That's the risk which you get. And you get 100% of that particular portfolio. So market wisdom is much more powerful. They know when to price a particular stock and
Right.
when to take it out.
Right.
Right. That may not suit a particular style of active fund manager. Okay. Another example I'll tell you about styles of investing, value and growth. Till 2 years ago, 2.5 years ago, value style delivered in India single digit return, that's on lower side, 8%, 9%. Last 2.5 years, value style is the style which is working.
Right.
It's the most performing. It outperforms all the styles. Right. Now look at value style active fund managers. They started very late. A lot of guys added PSU stocks and PSU bank after the value of 1 year because they were not comfortable. Because that's their style of working. Okay, so I'm not saying that's right or wrong. They said, I'm not comfortable at this valuation. I'm not comfortable at a particular sector. So that's the call they took. But market picked up. And the outperformance in the value active and passive is 20%. Now this is on the active passive. I'll tell you now example of two indices of two different NSE and BSE. If you take quality index, there's a BSE index, there is a NSE index. Within this also, there's a difference of 10%.
Of two passives?
Two passives.
Like Sensex versus Nifty?
No, there is a quality index,
Right, okay.
which is a smart beta index.
Right.
Okay. When they look at a particular style, so there are parameters, right? So NSE looks at 4 parameters, BSE looks at 3 parameters. But because of the 3 parameters, there is a huge alpha delivered.
Right.
Okay, but there is nothing right or wrong in passive also. You have to also understand what that active fund manager is trying to give you. Same thing, you should also understand what that a passive index is trying to give you.
Right.
How he is selecting a particular stock, why that particular stock should be part of it. Am I comfortable with, and then you should invest.
I'll go to the next topic, which is how investors should think about this. So, Ashish, first, like, if an investor is thinking about putting money into mutual fund,
Sure.
how should they go about? Like, there are so many mutual funds, there are so many fund houses. Within each fund house, there are multiple funds.
Sure.
So, how should they go about thinking about where to kind of...
So I think one thing everyone really should look at is long-term track record of fund houses. The second thing they should always look at is what is the portfolio of the fund they're looking to invest in.
Right.
And again, it's very easily available, very well disclosed, updated on a monthly basis, because what an investor needs to get is comfortable with the thought process a fund manager has. And that's best reflected in his choices in the portfolio, because market has cycles, styles have cycles, alpha is cyclical, but you need to hold your investment for the period of time, right? So, and again, going back to Vikash's example, that value had underperformed and then came into favor. So people who just look at price performance may have actually exited right at the worst possible time.
Right.
But people who were comfortable that, okay, what are the companies a value guy is owning or the growth guy is owning when the growth style is out of favor, will continue to own it for a longer time. And I think Vikas made a very good point, is that dispersion in returns is visible in active funds as well as passive funds, right? So within passive, there's a large bouquet of funds, right? So you can buy Nifty, you can buy Sensex, you can buy the Nifty 500, you can buy Nifty Next 50. The return differential gap is much wider, right? And I think what investors need to be cognizant of is that you just don't look at past return or 1 year performance, short-term performance, and make your investment decision, right? Because even, so if you look, for example, last 1 year, Nifty Next 50 has beaten by what, 25%?
Yeah, almost.
Nifty 50,
Yeah, right.
Both are passive funds,
Right.
So there is cyclicality in return even within different segments of the market, right? Because very few passive funds mimic the entire market, right? If you mimic the entire market, then managing the tracking error in a passive fund is very, very difficult. So you are typically trying to mirror one part of the market, right? And returns may come in that part or returns may come in the other part. But that's why I think the most important thing, whether it's active or passive fund, your choice is that what makes you comfortable to be invested in that fund, that style for a long period.
So basically, there is a segment of the market, and as an investor, you need to be comfortable with the risk return over a long period of time. So the risk return of a small cap will be very different compared to the risk return of a large cap. Small cap likely will give much better returns, but also when it goes down, it will fall much more compared to a large cap. So you need to figure that out. And B, within that segment, which fund manager feel more comfortable with? For which is, as you said, lots of data is available around, some technical as well as you can look at the portfolio manager and so on. Because how about passives? Like, let's say if you take Nifty 50, and I'm sure Nifty 50, there are multiple funds which are tracking Nifty 50. Are all of them the same, or can you differentiate, and how do you?
One thing good SEBI has done is, if you are tracking Nifty 50 index, you have to name exactly that index.
Right.
So there is no confusion. Somebody is managing Nifty 50 with 40 stock, 50 stocks, it will not happen.
Right.
You have to exactly name that index. So that's the transparency from the regulator front of you. So if you are a Nifty 50 index fund, everybody does the same thing. How do you execute? As I mentioned, how closely you are able to track, how do you closely able to cash flow and rebalance? All those things are very important for any passive fund manager. So that's the difference, which is called a tracking difference and tracking error.
Right.
Now, you'd like to add, people only look at tracking error. Okay, but I'll just spend some time on what is tracking difference and tracking error and why investors should look at both the aspect. Okay, what is tracking difference? Suppose we look at 1 year return of an index and a fund, index fund. The difference is called tracking difference.
Right.
That is because of the expense ratio, because of the brokerage cost and execution challenges and all, right? Now, when you do this tracking difference on daily basis, for last 1 year, there are 250 trading days, right? When you do this on everyday basis, tracking difference and do a standard deviation. Basically, you look at the consistency of tracking difference is called tracking error.
Right.
So, tracking error tells you what is the consistency in your tracking difference. Okay, so one may have a tracking error lower, but tracking difference higher.
Right.
So one may run at a 1% tracking difference. Okay, and error, his tracking error may be 3 basis. That's why one investor should look at both tracking difference as well as tracking error. That's the way to choose any index.
Right. And this data is available.
This data is publicly available. In fact, SEBI went one more step. It is daily available.
Right.
Earlier it was only available for more than 1 year fund. Now they have to update on daily basis. What was your last 1 year tracking and tracking difference?
Right. So it's available in the fund house's website.
On the website as well as on MFI website.
On MFI website. So they can go to MFI website and they can look at all tracking differences, tracking errors and so on. And tracking difference is the difference from the index returns. Tracking errors is the consistency of the difference.
Correct.
So in some ways, tracking error is the execution kind of indicator, and tracking difference is, how much cost you're bearing kind of an indicator. You mentioned, Vikash, that if you look at the US and Europe, etc., passive funds are already very, very large. Maybe 80% of the money is going into passive funds. In India, that number is 14-15%. So how do you see this evolving going forward?
I'll just correct this number. The globally 51% actually is in passive.
Right.
And the rest is actually in active, but this active is not in mutual fund industry.
Right.
The most active money is into hedge funds.
Right.
Okay, because they take huge risk. Okay, so why does that happen? Right, passive also helps you to make your core portfolio and increase your appetite to take risk.
Right.
Suppose I have 1 lakh rupees. Okay, I want to invest that. Right, but how do I make sure that I get higher return on that? If I go everything that money into a risky strategy, right, I may lose also. So I have to manage my risk return as well as cost. Okay, so that's why they do it. It's almost 50%. It's an average number 40, 51 and 49. But most people have larger chunk in passive, and the rest they money invest in hedge funds or a high risk portfolio. What happens end of the day? Your overall cost comes down, overall risk comes down, and there are chances of higher alpha in longer term. In India, these numbers are like 17% approximately active and passive, but which includes debt also. If you look at only equity, it's much lesser. Again, it's more of a government mandate which you see. But yes, investors have. So what has happened last a decade or so, because there is no consistency of the alpha, a lot of investors started asking question, why should I pay that higher fees? Okay, and that a lot of styles have undergone that their periods were not working. So investors started looking at what is the low cost option for. So they also realized that I should have one passive fund or few passive funds in my portfolio to overall reduce my underperformance, and this will grow. Okay. So one is the simplicity. When you want to take this 4 crore investor, 10 crore investor, simplicity will help. That's where passive will help to garner more investor and increase participation in the equity market. As the risk appetite grows, they can get into active, they can get into PMA, AIF, other index also. Another thing which is happening is smart beta, which is a passive plus strategy.
Right.
So you take a particular index, particular universe, maybe Nifty 50, maybe Nifty 100, Nifty 500, and put some mathematical filters.
Okay.
I'll tell you, give a couple of examples. You look at momentum. Momentum is look at price returns. Okay, which are the best stocks in say Nifty 100 have delivered price return. Now you don't look at the fundamental reasons. You don't look at technical reasons. The only parameter is price return.
Of course, price return is just to clarify.
It's a return.
Meaning the return of the stock.
Return of the stock.
Right.
Okay. So basically, the fund buys those stocks more which have performed. So if a stock, let's say over the last 3 months, 10 stocks have outperformed the index, then that
will buy more of those 10.
Here in India, we also added that risk-adjusted return.
Right.
Globally, it's more of a price return.
Right.
You don't look at standard deviation. You look at that. So you look at consistently some stocks have done. Those every 6 months you buy those stocks, right? That style. Another style is low volatility. You just look at the standard deviation of the stock.
Right.
So you take a universe 50-100. You look at the lowest standard deviation stock in the portfolio. Basically, those stocks, those low volatility stocks are also quality stocks.
Right.
So you buy a quality stocks, you buy a low standard deviation stock. So these stocks are actually basically help to reduce risk in the overall portfolio. So anything happens in the market, tomorrow market falls, these stocks actually will fall lesser. Why? Because they are defensive in nature.
Right.
So you also have a value filter. You also have a quality filter. So you take a universe and put these filters and create different portfolios. Okay. So these are they are called smart beta or also called factor style.
So
of
they are
investing.
still passive.
They're still passive because there is an outcome which you come. So
Right.
out of 100, maybe a 30 stock portfolio would come.
Right.
Right. And again, there's an index.
Right. Understood.
So you know exactly these 30
It's a
stocks.
synthetic index, maybe, like you have created the index, right?
It's not. It's NSE and BSE. It's a
NSE,
third party.
okay.
Yeah. It's a
Okay,
third party index only. And you replicate.
Right.
Globally, factors have actually, they use it for tactical allocation.
Right.
So they look at the market valuation, market indicators, and they get into value style, they get into growth style.
Right.
Okay. And they have outperformed consistently. It's more than 2 billion market now
Right.
globally. 2 trillion market.
Right.
It's a huge money which is getting invested in factors. So it's
Right.
actually gaining popularity. India, it's still like we are only for 14,000-15,000 crore in factors because it's a new style, 2-3 years of only existence. But such options, secondly, thematic styles, okay, sector style. So passive will actually help you to also navigate if you want to get into a particular sector,
Right.
a particular theme,
Yep.
which is probably may not available in the active space,
Right.
because of the concentration of the portfolio or risk of the portfolio. That also allows, but it also offers you a broader like Nifty 500
Right.
kind of, it's fund has 500 stocks in the portfolio.
Right.
So there is a simplicity also, but there is also complexity. Complex products are getting developed in passive space.
Right. Since you're the topic, can you also throw a little bit light on quant funds? And since you also run those, so what are these and how are they different
Exactly. So these are factor style which I mentioned, smart beta, are
Right.
actually quant.
They are quant
style
funds,
only.
okay.
But these factors are transparent quants.
from? Right.
You know exactly what is the filter. So suppose if you calculate standard deviation of a particular stock, if I calculate, it will be same. Correct?
So investor is fully transparent on what
On the factor
Factors
styles,
element,
are actually
right.
quant strategy only.
Right.
When you say quant as a strategy, there are multiple factor layers goes into it.
Right.
Okay, so in a particular fund, the fund manager would choose some growth style stocks also.
Right.
He would also want to have a lower standard deviation stock also.
Right.
He may want to look at a value style as well,
Right.
right? So such or high dividend yield style also, or the size. Size means mid, small. So there are multiple factors goes into to build a quant portfolio,
Right.
which can be as low as say 10-12 factors to 100 plus factors also.
Right.
Okay, so quant basically it's trying to do what it's trying to do a job which a fund manager or a machine is trying to do. So there is a set rules. Okay, you put stocks and there is and you put rules. Okay, what is it you are trying to do, and there is one result which comes out.
Right.
So quant is you can't say actually a pure passive, but yes, they are.
It is kind of passive.
It's actually not completely active also.
Yeah.
But those active filters are put in that analysis so that there is a result which comes out.
Right.
And this is also gaining popularity.
Right.
People are saying, that yes, I know there is no person behind, but of course there is a thought behind of the fund house.
Right.
Right. Their credibility goes there. And then these are the filters I know fund manager trying to put, and he's trying to create a portfolio.
Right.
Right. So this is also a style which is gaining, and this will be again a huge style. The way you're looking at passive funds, I think this is also a very big AUM which can garner. Currently, because people still think it's a black box.
Right.
Because I have seen 190 factors in one portfolio.
Right.
Can you imagine how will you explain this to investors?
Right.
That's where these smart beta factors are getting popular.
Right.
Okay. But as an involved investors, they are looking at these styles.
Right.
This is a style where, I don't have to too much depend on a fund manager, but I want this element also.
Right.
Just I don't want a pure market. So this style will actually, and this style will actually grow not only in mutual fund format, in PMS and AI format also.
Coming to you, Ashish, if you look at these styles, the passive, quant, etc., these are not really kind of fundamental driven, right? So
presumably they come with their own risks. What are those, and kind of how should one think about those
So
risks?
I think, as Vikash also explained, that these styles are again trying to beat the benchmark.
Right.
Right. So I think they are trying to do the same job as an active fund manager, but they are trying to do it with a set formula.
Right.
Right. And so first we said that they are passive fund who are going to beat the benchmark. Right. Then you are looking at passive fund who are going to meet the benchmark, and then you have other fund style which are trying to beat the benchmark. Right. Now, how do you best beat the benchmark? You can entrust a job to a human of your choice, or you can entrust to a formula of your choice, right? So there are various quant, there are various rules. So that's the bet investor has to take. What kind of suits his appetite the most? The this that comes in is that if too many people bet on the same strategy, right? Obviously, it won't be the
It'll be
best
priced
one.
out, yeah.
It will be. The second is that willingly or unwittingly, we all fall prey to momentum or price action.
Right.
You will always find the maximum investment in any style, in any theme, happen at its peak.
Right.
Because the return from that theme has been best at that period of time.
Right.
And so why we talk about herd mentality concerns for the fund manager, I think it is as much or even more there even with investors, right? And so that's the challenge, that one should not, using these, invest really at the wrong time.
Right.
And so, for example, tech funds in India sold the most in the 2000 tech boom, right? So getting into any particular style or any particular theme, one has to be very cognizant that you are not getting into the risk of investing with the herd, because that over time really means that your future returns are going to be compromised. So I think that is one this an investor needs to be very cognizant of, and therefore the diversified, either you go with a diversified fund or you invest in diversified funds.
Right.
Right. So you invest in, so don't go with a single theme, you go with multiple themes.
Understood. Are there any market level risks? Like one worry constantly one hears is that because kind of a lot of money comes through the passive route, the ETF route. Let's say if the market starts to fall, then it'll exacerbate that fall. Or if the market is going up, it'll just kind of keep adding to that. So you see any risk of that kind? And questions to both of you.
So I think, frankly, that risk is there on both active and passive side, right? So even in active fund, you kind of see a excesses being built up when so market bubbles were there even when they were just active funds. Market bubbles are there, and theoretically they can be even more when passive funds are there. So I think that is a risk of the market that will always be there. I think with passive funds, my concern is that the liquidity risk kind of plays out a bit more because really passive funds have a lot less of choice, and also for the investor, people who act faster kind of have a certain edge over kind of investors who are slower to react, right? So I think that is there. Thankfully, I think in India and even globally, yes, passive funds are large, and you earlier spoke about how does price discovery happen. The fact is, we are talking about only what proportion of the market, what proportion of the AUM are active and passive, right? But the market is much, much bigger.
Right.
So in India, domestic funds, mutual fund, insurance, all put together are the sliver of the total market volume.
Right.
delivered market volumes in a stock are only 20 to 40% of the average traded volume, right? And delivered traded volumes are with institutions, with retail, and within institution there are institutions of various hues and colors, right? There are mutual fund, insurance companies, foreign investors, etc. So I think the price discovery happens across all of these sets, including retail, including arbitrages, including F&O participation. So I think as of now, we don't see the industry is of the size and skill that they are determining the market out.
Right.
I would add here, this is another argument which comes in, as an active fund manager, he can hold some cash in the portfolio and, wait for market and deploy it. I was just going through some numbers before coming here. We are at the peak of the market. The entire industry has less than 5% cash holding, which is a 1.5 lakh crore currently.
Right.
In the main cash, and that's including all 40 plus mutual. Passive, 100% invested.
Correct.
So there is a risk that, so the numbers are not so huge because as Ashish mentioned, money comes at the top.
Right.
The momentum brings money, right? And if you are staying out of the market, you're not sure whether market goes to 26,000 tomorrow and you're staying on cash, right?
FOMO.
Yeah, exactly. And that's what actually market has done for last 1 year, right? You don't know when markets are just growing, right? So you have to be in the market.
Yeah.
Okay, so that risk is common to both.
Yeah.
Right? And you cannot, unless you're an asset allocator portfolio, you can sit in cash.
Right.
But any equity portfolio, you cannot hold in cash for so long. So that risk is both is almost similar.
Great.
The holding of cash actually is not just from your return perspective, it is from an investor perspective. Right. So what happens is that if you have a holding of 50 or 100 stocks in your portfolio, right, a retention comes in, right, and the impact cost on some of the stocks will be very high.
Very high, yeah.
Right. But if you have certain cash holding, then the impact cost will be relatively low, right? So it's not just trying to create alpha by having cash; it is also trying to have liquidity for the investors to have convenient entry and exit without really impacting the fund returns.
Great, Ashish and Vikash. Fantastic conversation. Thank you for your time. We covered today active versus passive, or versus is the wrong word, active and passive funds. We started with this understanding what active funds are and what passive funds are, and they're the big difference, what you highlighted. In the active funds, there is a fund manager who's taking some decisions on what stocks to buy versus not. The passive fund basically tracks some index. And so there, basically, the fund manager's job is to just do the execution in a seamless manner. Globally, passive funds have grown dramatically. They are now 51% of volumes, as we discussed. In India, that number has also grown. It is now 14-15% of volumes. We had this interesting debate on why active versus passive, where we spoke that 60% of funds by numbers underperform the benchmark, but 100% of passive funds actually underperform the benchmark. It is not so much active versus passive, but what your portfolio is, because the passive delivers to a certain outcome, which is, tracking an index, being risk adjusted, and, not simplicity of making the investment decision, versus the active, which is tracking maybe a separate objective, which is to get a slightly higher alpha and to invest in a particular theme or behind a particular style. And so it is not so much a question of A versus B. It's a question of how you get A and B together and build a portfolio that works for you. So we spoke about that. We spoke about risks in both styles. We also spoke about how investors should make choices and how they can access. So passives, we have ETFs and we have index funds. Actives, obviously, we have like a whole bunch of mutual funds that are available. Within that, we spoke of how you make choices based on your risk appetite and your risk return expectations. So you look at segments, you look at the investors, the fund manager style in case of active. In case of passive, you have to look at the tracking difference and the tracking error. All of this information is available publicly, very conveniently for investors. You are encouraging everybody to go out and do their research. And if they don't want to do their research, they should invest in Access Mutual Fund. Thanks a lot for that conversation, Ashish and Vikash. It was great having you.
Thank you so much. Thanks.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.